Hello everybody, this is Toni Turner and welcome to the market now as of Friday, August 23rd, just before the markets close. Well, Wall Street's three main indexes have lost way more than 1% today after President Donald Trump ordered U.S. companies to immediately start looking for an alternative to China in response to Beijing's threat to impose retaliatory tariffs on U.S. goods. Earlier in the day, China vowed to impose additional tariffs on goods worth $75 billion that include agricultural products, crude oil, small aircraft, and cars. Tariffs on some products would take effect on September 1st and others on December the 15th. So on that cheerful note, let's go forth and look at three charts that could give us some insight into the week to come. This is our daily chart as we usually look at of the S&P 500 spider, symbol SPY. Of course, this is the ETF that closely tracks our benchmark S&P 500 index. So as we're looking at this daily chart, as you probably know by now, the SPY made a new all-time closing high on July 26 at $302. And 1 cent. That's about 30.20 on the S&P 500 itself. You probably also know that since then the SPY has fallen. And when I captured this chart today, right before the close, the SPY was trading at $284.94. That's about $28.49 on the S&P 500 itself. Now, as you all know, or as you can see here, the green line is the 50-day moving average. The black line is the 200-day moving average. The red line's the 20. They're all simple moving averages. For some time now, actually since the end of July, the SPY, S&P 500, you could say, has been caught between, trading in a range between the 50-day moving average, which is coming in now at $294.25. That would be about $29.40 on the S&P 500, and the 200-day moving average, which is now coming in at $279.94, about $280 we can call it, or $2,800 on the S&P 500. So the SPY has been caught between these two lines. It's been falling hard, jumping back up, falling back down, jumping back up, but it hasn't been able. It made a tiny little close here above the 50-day moving average, but it hasn't been able to stay above that line or above 294. So we're caught here in this range. Now the 200-day moving average again is coming in at, we'll call it $280 or $2,800 to make it easy. We also have a little support here at about 282. That would be price support for the SPY. So as long as the SPY can stay above the 200-day moving average at about 280, as long as it can stay above that, that's where we would like it to stay. So that's the line to watch. I suspect as long as it does, that buyers will come in to buy the dips. Now, should the SPY dip below this line, again at 280, right now, we could see another leg down in the S&P 500. Now we do have this June low here, which is a tiny, tiny, tiny bit of support. We could even say it goes back into March, and that comes in at 273. So that's a little bit of help, but there's not a whole lot of, probably not a tremendous amount. If the S&P goes below the 200-day moving average, again, that will cause me to become quite a bit more conservative and defensive as we go through August. And please know, August, as I told you before, is usually a cranky month. Now, if the SPY just fools around here between the 50 and the 200, and then can gradually in the next week or two climb back above the 50-day moving average, again coming in here at 294, that would be bullish for the market. So yes, we're caught in kind of a funny space here. Again, August is usually cranky. So just be wise, keep your stops in, and be careful. sometimes I like to say to Tony's Market Club, sometimes the best thing to do is keep your mittens off the keyboard for a while. Okay, our second chart here is a daily chart again of the iShares Russell 2000 ETF, the IWM. We do watch the Russell 2000 small cap ETF as many times a leading indicator to the broader market. And right now I kind of wish it weren't, but it is. So we can see when I captured this chart here right before the close, the IWM is trading at $145.25. Now the IWM didn't, when back here in December when of 2018 and into January, when the other indexes came up, the SPY and the NASDAQ came up, they came back up to prior all-time highs, and then started all the angst in May and so forth. Something to watch is the iShares Russell 2000 made an all-time closing high here in April, and it never did back here in April at 161.11, and it never did come back to this all-time high like the SPY did and the NASDAQ 100. So it kind of told us anyway that we were having rough times ahead. Now the IWM is about 15% below this high. That puts it in correction territory. Anything trading at below 10% of its all-time high is in correction territory, and the iShares Russell 2000, the IWM, definitely now is. So when I captured this chart again today, the IWM was trading at $145.25. It does have an August low right here at $144.79. We're pushing our luck here a little bit, but who knows, maybe. If the IWM can hold here at 144, 145, then perhaps it will somehow get the strength and the buyers, which is what we need to rally up. It needs to come back up above the 50-day moving average, which is now coming in at about 153. If for in the next week it can come back up and rally above that, that would be bullish for the market. If the IWM has to fall and close below 144, then again we want to get more conservative, and there are certainly different ways to do that. So let's talk about that right now. Our last chart for the day is the VanEck Gold Miners ETF. This is defensive for sure. I use the Gold Miners ETF because if you get into ETFs like the GLD or the IAU, the IRS counts it as you're actually making a commodities trade, and the taxing is different. This is a little easier to do, and I think it does just as well. So this is gold miners, not the actual commodity gold. This is the VanEck Gold Miners ETF, again, symbol GDX. It has 44 components. Some of the top components are Newmont Mining, Barrick Gold, Newcrest Mining, Franco-Nevada Corporation. Now, when I captured this chart today, the GDX was trading at $29.59. You can see here that it was down much lower. Remember, when the market's in a bull market, gold, which can be a defensive play, usually doesn't do very much. We can see back in December of last year how it finally hopped up above the 50-day moving average, and that's, of course, the market was going down at this time. Gold was going up at that time. It finally hopped up above, as I said back in December, its 50-day moving average, and has been moving above it very, very nicely into March, fell again in April as the market went higher, and then bounced up pretty dramatically in May and took off, walking up its 20-day moving average. And of course, with all we have going on with China, the trade tariffs, geopolitical problems in Europe, South America, gold is just a haven that a lot of people choose to go into. Certainly it's a conservative play here, but you do have to pay attention. So when I captured this chart before the close, the VanEck Gold Miners ETF was trading at $29.59. If the market continues to be negative going into the coming week, I will add shares of the GDX to my portfolio, my trading account, and I will hold on to it as long as the market moves lower. And I'm going to hang out in some gold until more confidence returns from all these geopolitical situations. In this case, it's trading above the red line, the 20-day moving average. That's coming in at 28.49. I'm going to place a tighter stop here. You don't have to do that, but I'm going to place a tighter stop than I normally would. I'm going to place my initial stop at 27.50. And as long as the market moves lower, this will be kind of a hedging position or a conservative position for me that I think may work. Now, if the market starts moving higher dramatically, please know that gold will fall. The GDX will fall. See right here where it fell pretty dramatically a couple of weeks ago? That was when the market was moving higher. So you kind of have to think in a contrarian manner with this, and it never hurts to have a little bit in your portfolio anyway. But I'm going to keep this, again, with a fairly tight stop. I'll turn it into a trailing stop, a tighter one if it moves higher. So again, you may, in the coming week, if the market continues to move lower, you may want to take a look at the GDX. Make sure you put in your stop. And now for the upcoming week's economic reports. But first, join us for Tony's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading skills and your trading profits. We'll talk about which side of the market to trade. I'll give you a mini trading lesson, and I'll also give you stocks and ETFs that may become ripe for high potential trades. If you can't attend the live session, no problem. The recording is available to all of our members just a minute or two after the session ends. Tony's Market Club is a low-priced, high-value opportunity to learn more about the market, how to trade more successfully, and how to make more money. So please join us. For more information, go to the link on this screen or click on the button below. And now for the upcoming week's economic reports. Monday we have durable orders. Tuesday we have S&P Case-Shiller Home Price Index and consumer confidence. Wednesday we have our usual crude inventories. Thursday we have the gross domestic product, jobless claims, pending home sales, and natural gas inventories. On Friday we have the Chicago PME and the University of Michigan Consumer Sentiment Index. I should have said Chicago PMI. Again, join us for Tony's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading skills and your trading profits. Until next week, be careful out there. Keep green on your screen. I'm Toni Turner, and this is The Market Now.